the topic for this afternoon is carbon trading, specifically pathways to carbon credit mastery in Zimbabwe. I don't think we're yet at the mastery stage, but I think Zimbabwe is definitely headed in that direction and leading in the forefront of carbon market development. And so, just a brief overview of Cicada. Sorry, I double clicked there. Cicada is one of the largest diversified agribusinesses with extensive experience in sustainable business practices. As I mentioned earlier, sustainability is at the core of who we are and what we do as a business. And our operations are focused on sustainable agriculture, ecosystem restoration, carbon reduction projects, and renewable energy. So just in terms of a screenshot of our group companies, we have 4 portfolios, namely Cicada Agriculture, which is producing avocados and macadamias for export markets, Cicada Forestry, which is managing the border timbers estates, Cicada Carbon, which is going to be the main focus of our session today, and we have Cicada Solar, which focuses on commercial and industrial solar solutions. This gives you a snapshot of our sustainability strategy, and we have essentially narrowed this down to 3 pillars in our strategy. The first one being one finite planet, because we understand that everything we do relies on the earth, and therefore the health of our ecosystems is imperative to our long-term success. Our second pillar, people first, reflects the importance of everything we do being done by people. And so whether it's people within our business or people in our communities, we view that holistically within our ecosystem. And lastly, measurable impact, because everything we do and the decisions we make have to be driven by data. And through that pillar, we've now established Cicada Agritech, which is a soil and biological laboratory that offers soil testing, water testing, and other chemical and biological testing services across Zimbabwe. So why carbon? What some of you may not know, I know they mentioned earlier that I trained as an accountant, but what I actually studied initially in high school for my A-levels was biology and chemistry, with the intention of becoming a doctor, but landed up being an accountant. And now, a few decades down the line, the biology, chemistry, and accounting are all coming together to help us understand how to navigate carbon markets. And so, why carbon? I'll take you back to a biology lesson, essentially the carbon cycle. The way the Earth essentially moves carbon from one form to another form, energy is neither lost nor destroyed, but it is transferred into one or another condition. And what the world has done, or essentially what science has done, is taken carbon as a representative standard unit of measurement for all gases. So we know that carbon is not the only gas, but for the purposes of measuring emissions, we standardize all the gases into the equivalent of carbon. And as we see in the natural cycle, where there are carbon emissions and carbon sequestration, essentially that cycle is what is now evolving into the trading of carbon from essentially those who are net producers of carbon credits and those that are net emitters. So how did we get here? The problem globally around climate change can be summarized in the triple planetary crisis, which I won't get into in detail now, but essentially comes down to biodiversity loss, pollution, and climate change. And the graph that you see on your left essentially now shows the areas in terms of biodiversity loss, the lighter areas representing areas that have been most affected by biodiversity loss. And you can see Zimbabwe there you can almost make out where Zimbabwe is on that map. And then historically looking at the correlation, and it's a very strong correlation between industrialization over the last few centuries and the level of carbon emissions that we're facing. Interestingly, the energy sector is globally the largest contributor to greenhouse gas emissions, and the same applies within Zimbabwe. So you find a lot of focus, and a lot of the climate finance available has predominantly gone into climate mitigation activities with a strong focus on renewable energy, as we highlighted earlier. So what is the scale of problem when we think of it in a local context for Zimbabwe? Essentially, Zimbabwe is facing a national deforestation crisis, losing approximately 262,000 hectares of woodland every year. To put that into context, that is equivalent to the size of Mana pools or 3 times the size of Harare. And what is driving this level of deforestation, we've narrowed it down to 3 main drivers. There are several reasons, but primarily the first one is the basic need to put food on the table. Firewood consumption for heating and cooking in rural households, because 61% of the country's total energy supply is due to the lack of electrification, or rather the reliance on wood or biomass. The average household in Zimbabwe uses about 5.5 tons of firewood every year just for heating and cooking. And further down, when we look at our carbon project, I'll go into a bit more detail on that. Another quite significant driver is firewood use by the tobacco industry for curing tobacco. And so whilst we celebrate the record-breaking tobacco production that we are achieving, I think it also warrants time to reflect on what has been the environmental impact and the increasing demand of natural resources to make that possible. And lastly, expansion into natural ecosystems by small-scale farmers. Again, the essential need to put food on the table. And Zimbabwe, like many other countries affected by climate change, is realizing the impacts of reduced yields in agriculture. And essentially what that has triggered is now overexpansion of farm area, which also contributes to the deforestation in an effort for people to maximize or increase their yields. We also have another project that specifically tackles this issue. But when we look at the cost to solve the problem, and Zimbabwe is definitely ahead of the curve by the virtue of the fact that we were one of the few countries that submitted our NDC reports within the UN FCCC timelines. Zimbabwe has put out the NDC 3.0, which covers the period up to 2035. And essentially the investment analysis that has been done shows that we need 19 billion to achieve the targets within that. Now, what has come through in the discussions is that public finance alone will not be enough to successfully implement and achieve Zimbabwe's NDCs. And there's also been a lot of debate around why Zimbabwe has put forward such an aggressive NDC, considering that we are a small emitter by global standards. I think we only contribute 0.07% of global emissions, with Africa contributing 2 to 3% of those emissions. But what we see is an opportunity, rather, for Zimbabwe to position itself as a net exporter of carbon credits and be able to unlock the global climate finance opportunity through carbon markets to generate climate finance investment. So now looking at how we can essentially take a problem and be able to tap into the opportunity to fix that problem. I think what carbon markets have done essentially it has presented a market solution, because now for the first time, the environmental problem has a commercial attribute to it. By putting a cost on carbon credit emissions, or rather putting a cost on carbon emissions, this has forced industries to now essentially be able to confront the impact that production has upfront. So by placing this monetary value, we're seeing that emissions come at a cost. And what we're able to measure now, we are actually able to to execute strategies. The increases in costs of these high emissions is providing economic incentive to consumers and to producers to opt for lower emission products or production methods in their various sectors. I think what we've also seen arise in the last few years is the creation of demand. And it's a growing demand. Initially, the demand was purely voluntary, where the carbon market started off with just the VCM, the voluntary carbon market, where companies were volunteering through the Science Based Targets Initiative, setting their own climate ambitions and beginning to use carbon credits to a certain extent to offset the unabatable portion, or the portion that was not reduced within their scope 1. And so, however, what we've seen is a transition of these carbon markets into more of a national or compliance-based market. And so the opportunity for Africa at this stage is that the global north has accumulated a high demand for carbon credits. And at the moment, Africa is only producing around 2% of its annual potential of carbon credits. So when we look at the way the markets are structured in a little bit more detail, we have the voluntary carbon markets, which I've spoken about. And just to give you context on the variability across these markets, I've used an index of a cook stove carbon credit price in each of these markets. In the voluntary market, where there's been a lot of pressure on pricing due to integrity issues or suspension of carbon projects that have happened in the last decade, essentially we've seen a depression in this market. And as a result, prices have now come down to where they were previously maybe at $5, now trading around $3 or below $3. However, there is some indication of recovery in this market, essentially through integrity initiatives such as the core carbon principles, which again are private sector-led initiatives to enhance the methodologies and standards that are used to measure the integrity of carbon projects. Then we have the Article 6 market, which was confirmed or rather operationalized last year at COP29. I think Article 6 is something that has been in the discussions throughout the last few COPs. And finally, last year, countries did come to an agreement of a framework to begin to implement this mechanism. Under this mechanism, countries are now able to buy and sell carbon credits to contribute to their NDC targets. Countries that have managed to reduce their emissions, or rather are generating excess credits, are able to now transfer those credits to countries that still have significant carbon emissions that are not yet abated in their transition plans. So what we're seeing now is buyer confidence starting to grow and demand as well. I think you find countries like Switzerland have set out their policies where they're looking to purchase up to 40 million carbon credits over the course of their NDC period. And that means that Africa has an opportunity to tap into that by supplying those credits. Singapore is another country that's quite active in terms of Article 6, and we're seeing a lot of bilateral agreements beginning to be signed off. The main countries so far in Africa, I think Kenya has signed off quite a number of these MOUs, Rwanda, Malawi, Zambia, and I think I'm also pleased to report that Zimbabwe is working on at least 3 or 4 potential bilateral agreements now that we've put together our framework. The pricing in this market ranges to about from between $12 to $15. But again, it's not reflective really of the potential pricing in terms of carbon pricing in the global markets, global north markets. Then we have international compliance markets. This is now, again, sector specific, but at an international level, where your Article 6 will focus on a specific country and the country's emission levels. the international compliance is now looking at emissions across industries like your aviation industry, for example. And under CORSIA, which is the carbon offsetting mechanism for the international aviation industry, essentially what they've done is projected a demand of up to 250 million credits required by 2026. This is just under their phase one. And to give you context of the disparity between demand and supply, at the moment, there's only one project that has fully met the requirements, and that has about 15 million credits. So just by virtue of that gap, you can see the potential. CORSIA pricing ranging between $25 to $36 a credit, but if the supply gap continues, I think there are projections that this price could go as high as $90 plus within the phase one. And then lastly, looking at domestic compliance markets. And these are mandatory compliance schemes that have been introduced by various countries such as China. China has the largest ETS, emissions trading scheme, in terms of volumes, and by virtue of them being the largest emitters globally. We've seen Singapore create an ETS. The EU has established an ETS. Canada recently, as we mentioned earlier on. And so more and more countries are adopting carbon pricing mechanisms as a way to try and reduce the carbon leakage, or rather to level the playing field for local industry to be in line with the carbon emissions or the transition targets that they've set. And so when we look at the pricing within the various compliance sectors, Singapore is one example that I've put down, which currently prices carbon tax at between $17 to $18 per ton. So when we speak of carbon, we talk in tons. One credit is equivalent to 1 ton. And already the policy makers have gazetted that this will go up to about $35 by next year. In comparison, you have countries like Sweden who are pricing carbon at $140 a credit, Uruguay at $160 a credit. So when you understand the mechanism around ETS systems, I'll give an example. EU is pricing at around $100 per ton. China is probably the lowest at $12 per ton. Now, the way the mechanisms are working is if you cannot demonstrate that your company or your whatever goods you're exporting into that country have met certain criteria around sustainability or low carbon emissions, essentially when they benchmark them, there will be a tariff placed if you're not able to prove that as a business you have either paid for the excess carbon emissions or you have implemented measures to reduce your emissions. And when you look at a disparity between China at 12 and EU at $100, you can see why carbon tariffs can potentially have quite a significant impact on global trade and general tariffs. So now when we look at the green taxonomies, looking a little bit more around global supply chains, there are 3 areas that I've put down, but I think we've already covered access to finance in the previous session. And to an extent, we've covered the access to markets. And essentially now where the carbon markets are driving faster towards is a more compliance-based mechanism where a lot of the policies that are being introduced by countries are going to make this something that corporates cannot ignore. If you want to do business in certain countries, you will have to be able to prove that you are playing at the same level, or essentially you are taking the issues around carbon emissions seriously in your various strategies. I think we spoke about solar and the potential benefits around solar. I think something that I wanted to highlight is essentially one of the World Bank reports stated that Africa had managed to secure between 3 to 4% of global climate finance, which tells us that 96% of that climate finance went to other continents and areas outside of Africa. The main ones being Asia, Europe, and what we've seen in those countries is most of that climate finance has gone towards renewable energy or solar. And as a result of that, there are countries like Sweden who now are generating excess power. And as a result, their pricing in some of these countries is going into negative pricing. So the headache for power producers in other countries right now is excess supply of power and negative pricing by virtue of them tapping into climate finance and unlocking renewable energy. I think that presents a challenge even to Africa. Other developments in terms of compliance, I think following closely behind the aviation industry is the shipping industry. Shipping is considered one of the high carbon sectors globally. And just recently, the International Marine Organization Assembly met, and they have begun to implement a carbon pricing on shipping, which will charge approximately $60 to $300 per ton. Now, our understanding of business is that if a shipping company is going to absorb a cost of $300 per ton, that is going to need to be passed on one way or another, effectively. So what do these dynamics around carbon pricing mean for the cost of our logistics, the cost of our exports? But I think we have to applaud these industries for their efforts, essentially because what they're pushing the industries towards is an intentionality around low carbon efficiencies. And with that, I'll move on to just touch base on some of the sustainability-linked value additions that we can see on our corporate balance sheets. One of the major issues that African Development Bank has been pushing quite strongly is the issue of natural capital valuation. And they've estimated that if Africa was to put the value of natural capital on its balance sheet, it's equivalent to $6.2 trillion worth if we are to value that natural capital. That's almost 2 times our current continent's GDP. And so what are we missing out of in terms of opportunity by not valuing the natural capital within our business ecosystems or within our national ecosystems? And essentially now carbon markets or global climate finance aims to unlock the monetary value to natural assets that have previously been undervalued or rather ignored. When we look at just the classic example of tobacco, are we including the cost of the trees when we're costing the price of tobacco? Are we including the environmental impact cost for mining activities when we look at the costing of that? So without taking into account the vast natural resources that Africa holds, it's again a potential opportunity that can unlock financing. And I think in terms of carbon project development, one area I wanted to highlight is around technical audit expertise. At the moment, most of the auditors for carbon projects are based outside of Africa. Most of the auditors that we've dealt with specifically on our projects come from India or Europe. And so again, it demonstrates that Africa is falling behind some way, somehow, because we are not yet building the technical expertise in our pipeline to support project development. So I think that presents an opportunity for people in the accounting and auditing profession to also find these opportunities within the carbon value chain to become participants in what is in a rapidly expanding global market. So what are we doing in Zimbabwe and where are we so far? Zimbabwe has developed a very advanced and robust Article 6 framework and climate change management bill, which is currently under review at Parliament, with the focus or aim to attract climate finance investment. What we have achieved in Zimbabwe is currently the first national blockchain-based registry. And I think when it comes to carbon, Zimbabwe has generally been in the front line of development, although we've also been hit with quite a lot of sort of publicity, negative publicity, where we've faced challenges in some of the projects. But I think we need to applaud the fact that Zimbabwe has been quick to move forward and find solutions. Over the last 2 years, since carbon markets were suspended or carbon trading was suspended by SI 150 in 2023, government has taken the last 2 years to engage with private sector and key stakeholders to come up with the framework that is now globally recognized as forward thinking. And to give you some insight into that, I'm going to show you a headline in one of the carbon publications that came out today, which essentially is applauding Zimbabwe as being the second, or rather having the second project in the world to potentially be close to achieving COSIA eligibility. Remember, I mentioned there was the one project in Guyana with 15 million. At this stage, Cicada is the second project in the world that is lined up to be able to meet these requirements. And that's happened with the support of the policies and frameworks that we've put in place in Zimbabwe. So just to give you a little bit more insight of what exactly is within the frameworks that have been developed, I think we've already mentioned that it's a blockchain-based registry, which again is intended to give confidence to investors around the transparency of blockchain. I think blockchain is very complicated, and the intricacies of the serialization and audit trail within it make it very difficult for anyone to try and manipulate what you've put into a blockchain registry. And again, what Zimbabwe has also done in the framework is to ensure, or rather mandate, for all credits generated in Zimbabwe to be eligible for Article 6, which positions carbon project developers in Zimbabwe to be able to trade on the compliance markets and not just on the voluntary carbon markets. And that in itself will have an advantage. However, the framework does make carbon one of the highest taxed sectors in Zimbabwe, because the carbon levy is currently at 30% on all gross issuances generated by a project. And where you generally would talk of corporate tax being 25% on the net profit, having operations taxed on revenue, or rather on gross level, at 30% is quite significant. But I think here what government essentially has put forward is to say, without this Article 6 framework, projects would not qualify for the compliance markets that come with higher or more premium pricing. So there's a trade-off there between projects and policy, but unfortunately not all projects will be able to realize the benefits within the compliance markets, and so the engagements are ongoing. Within the climate change management bill, I think something key to note for industry is that there is contained therein a domestic compliance market for Zimbabwe, where in the future, Zimbabwean companies will also be given emission caps. And if you are trading above that cap, essentially the cap and trade mechanism for ETS, as we mentioned, charges a tariff for emissions above the allowable level of emissions. Also contained within our national bill is a climate fund. And the purpose of this national climate fund is that 30% of all the credits or the revenue collected from carbon is supposed to go towards funding that 19 billion cost that we mentioned earlier for Zimbabwe to meet its NDC requirements. So when we look at the process flow of what a carbon project in Zimbabwe has to do in order to meet the requirements within the framework for registration, it's quite a lengthy process, and it's quite a high cost intensive process. And I think that in itself requires us to adjust our mindsets to say carbon is not a low cost barrier sector. I think with the level of investments required for registration, both on the Zimbabwe market and also with the international carbon standards. It is a significant cost investment that goes up front, followed with the monitoring, reporting, and verification costs. But essentially, I think your creation of account, you're talking about $2,000. But for registration, you'd be looking at between $10,000 to $20,000. We've mentioned the 30% on the levy, and there's probably an additional 60 to 40 cents per credit that's charged in other fees on these projects. So with the background that we have now on what the carbon markets and Zimbabwe's framework currently entails, I'm just going to wrap up by giving us a synopsis of 3 of the carbon projects that Cicada is working on. Our primary project is the cook stove project, which relates to the video that we watched at the start of the session. And we have currently distributed 120,000 stoves and are working on scaling this to 500,000 stoves by 2027. What I'll mention is that within the framework SI 48 of 2025, government has established a transition or a pathway where carbon projects can distribute biomass stoves for the next 3 years. Thereafter, we have to transition to cleaner cooking methodologies, i.e. ethanol cook stoves or LPG cook stoves. So essentially, again, from a community basis, it means channeling the carbon revenues to then be able to upgrade the cooking technologies within these communities over the next 3 to 5 years. The benefits, I think I won't go into in much detail because you've had some sight of those benefits in the video. But essentially, I think in the video we were talking about the habit surveys that have been done. To date, we've conducted about 16,000 surveys, aiming to conduct 25,000 surveys by the end of December. Why is this important? It's important because at the heart of every project, the question around integrity and data is important. You have to be able to demonstrate the additionality of your project, the community benefits of your project, and this can only be established by interacting and engaging the people in the communities. So we have field officers that go out into these communities and spend considerable amounts of time. The numbers that we've developed around, or the baselines rather, around usage of firewood, that 5.5 tons, has been based on an equivalent of 3,600 days of kitchen performance tests. People in the households measuring firewood usage, observing usage, and then using that sample information to inform the numbers for the project. The second project, thank you. The second project I'll highlight is our small-scale farming. As you'll recall, I said of the 3 major drivers, one was cooking, but the other one is food security. So through our small-scale farming project, we are training farmers in conservation agriculture practices based on the regenerative agriculture techniques, also known as foundations for farming, aka Pfumvudza in some areas. And so by implementing these conservation practices, we are seeing farmers being able to increase their yields by up to 400% on maize. And that's contributing to increased food security, but also increased income for the farmers' households. And most importantly, it means that farmers are not forced to expand their farming areas. They are merely just now improving the efficiency of the 0.25 of a hectare that they have. Over the 3-year program that we train the farmers, the best performing farmers graduate into our export value chain, where we provide them with free avocado seedlings, and then the plan there is to ultimately integrate them into our export chain. So our target at the moment is to be able to grow the small-scale farming project from 800 farmers and be able to hit 6,000 farmers by 2027, with the goal of then also generating carbon credits from the improved soil health conditions and a measurement of the enhancement of that soil health through carbon. And lastly, I'll highlight the ARR project, reforestation or restoration. Cicada is working with an NPO called My Trees. My Trees has embarked on tree planting exercises where we are planting indigenous trees across Zimbabwe. To date, we've planted 1.6 million trees. And from next year, the target, once we've also secured the funding, is to be able to plant 1 million trees per year. The project pays the communities to essentially look after the trees. So each household for your 1 hectare of trees is paid revenue to incentivize why someone should keep this tree there for up to 20 years. So they may not be paid for the full 20 years, but in the early stages of that tree life, there is revenue for the households. And that revenue is funded by the carbon credits that will be generated from this project. So that's a snippet of what we are doing as Cicada and partnering with the likes of My Trees to essentially unlock financing opportunities through our sustainability initiatives. And I'll invite you to then scan the code, QR code, to view our website, our company profile. And I think if there are any questions in the room, Pascal, we can also open it up to questions. I've done most of the talking so far, but I'll also give others an opportunity if there are any questions. Thank you.
There are any questions? Yes.
Sorry, was I correct in seeing $1.50 per tree is your cost?
Yes.
How?
So we talk of it's about 1,000 trees per hectare, and essentially costs about 1.5. So the major costs with an afforestation or reforestation project is the amount. Like I said, we're paying the communities to take care of the tree. And so that process of then monitoring and essentially verifying or making sure those trees remain secured or protected over the project life. And the project life is about 20 years. So you essentially have to take into account what it will cost you to generate that credit over 20 years. So it costs you a lot less to save a tree than to try and replant a tree. And which is why, with the way we've structured our projects, we leverage on the cook stoves, which are avoiding deforestation. Let's cut down less trees, and then using the funding from those lower cost of abatement projects into higher cost of abatement projects like ARR.
Good afternoon. My interest is in finding out whether at the end of the day we have a market and price discovery. Because we've got Wange sitting on one side of the country emitting carbon dioxide. Then we have the Forestry Commission in Nyanga generating trees. How do we get a process whereby we can have a market where then Wange, to comply with certain requirements, then buys the necessary carbon credits for compliance, for instance. Because it doesn't look like there's an established market where these things can be done. And then you've got the sophistication of places like Zimbabwe to say that a lot of us don't quite appreciate what the carbon credit is. Whether there's a register somewhere where if I wanted carbon credits, I'll find out how many Forestry Commission has. And then I can have a bid and an offer and the strike price. And therefore, at the end of the year, if I have carbon credits on my balance sheet, I can value them.
Okay.
I hope you get what I'm getting at. It's a simple market.
It is, and I think this is where I'll answer it in 2 points. Firstly, what you are raising as a question really becomes another opportunity because the underlying problem is data or lack of data. And so, whilst we're now driving reporting of sustainability, I think we can all see how there's going to be value to the data that we're generating. the ability of corporates to measure their emissions, the ability of corporates to measure their environmental impact. We can't manage what we don't measure. And I think it's an important call for all organizations to say the time is now to start measuring that environmental impact. In terms of market, I think what we've seen based on the global overview that I've given is the market demand far exceeds what is currently available as supply. But where Africa can potentially miss the opportunity is whilst we are trying to organize ourselves, Asia, Europe, South America, America have all positioned themselves to generate technology based credits. They don't have the advantage that we have in terms of natural capital. But now you find their projects around carbon capture, and all these other technologies. So they're going to generate this green hydrogen. We're not even anywhere close to generating green hydrogen in Zimbabwe. But what we're saying is the opportunity is with the natural capital that we have, how can we be more intentional about unlocking or accessing this global climate finance through carbon markets as one example of climate finance. Locally, I think price discovery will come once the ETS is established, which is in the bill but not yet enacted. But we have already very mature global markets that are trading. You've got the ICE Intercontinental Exchange, you've got quantum commodities. There are all these platforms that are already tracking and reporting on carbon pricing. 5 years from now, carbon credits, essentially, we'll be talking about them as the same way people who invested in Bitcoin are talking about Bitcoin at some point. But I think the reality is now that there's more compliance markets through aviation industry, the demand is not going to go away because these things are not going to be reversed.
That's great. Thank you. So I'll just give two last questions, and then there is a QR code and also a link that has been sent in the delegates group. We can post our questions using that link. Just click that link and then put your questions.
Thank you, MC, and thank you, ma'am, for your presentation. But I couldn't help to think, you spoke about one of your projects, which is something based on solar or solar farms and things related to that. I couldn't help to think, what are the long-term implications of massive solar farms? I don't know if you've had any researches around that. I know I read something randomly somewhere that was talking about issues of lead, long-term issues of lead, electromagnetic emissions in the long term coming back and having the same harm that we're trying to solve with the solar farms. So I don't know, maybe you could talk to us about that and tell us what you're doing with the long-term effects of solar farms.
So that's a very challenging question, Sibo. I don't have an answer. But what I've seen and known is that technology is advancing very rapidly. And you'll find if you Google the solar technology available today, it's well ahead of what was being used even 5 years ago. And so I think what we would foresee is a transition where the markets will continue to evolve and technology will continue to grow. Green hydrogen, I mean, who would have thought we would be able to produce green hydrogen? And it's something that is being exported between countries. So I think there is an impetus to drive a more sustainable pathway for the energy sector, especially. And what I also find maybe in terms of, we're talking about what happens 50 years time, etc. It'll be interesting to see. China has just released their NDC, updated NDC, and they've put through their pathway or their projections up to 2065. They've given themselves up to 2030 to reach a peak level of carbon emissions. And I think what China has done is they've essentially looked at all the additional industrial advancements that they're making. And also because they had recently introduced or commissioned thermal power stations. Europe has started decommissioning thermal power stations, and yet some countries are still installing new thermal power stations. So it might not speak to solar, but essentially it shows the pathway where we are seeing thermal power being transitioned out in a lot of global north countries. But developing countries are saying we still need to rely on thermal power as the starting point until we reach a certain level of industrialization. So I think the challenge there remains to say, how do we continuously evolve to ensure that technology does ultimately address the long-term effects of all technologies?
Okay. I came across something that I thought probably you could comment on, the Kariba Red issue, where I think 15 million carbon credits with regards to Zimbabwe are being contested, so to speak, or they're asking for a refund. Number one, what does that do to our carbon markets? And secondly, what went wrong?
I can't speak to what went wrong. I'm saying just one more question at the back. I can't speak to what went wrong. But I think to give you some insight into the evolving of methodologies. Again, remember we said Zimbabwe was in the front line 10 years ago, where there were very few RED Plus projects. But what you've seen is from the time that Zimbabwe started the project until now, there's probably been about 5 to 8 revisions of that methodology. And so, because there's more scrutiny on carbon projects and the science behind carbon projects, it's forced the market to invest in more R&D, research and development on enhancing those projects. So perhaps based on the methodology that was available at the time, there would have been no major issues. I cannot comment on that. But I do know that there are now more stringent methodologies. And it's unfortunate that with carbon, the methodologies can be backdated in many instances. And that is a risk that project developers are also having to weigh. I'll give you an example with cook stoves. The initial methodologies for cook stoves allowed Zimbabwe to use an FNRB number of 79%, being the fraction of non-renewable biomass. With effect from January 2026, the new methodologies are requiring projects in Zimbabwe to reduce that factor from 79% to 21%, which means you're going to lose potentially 70% of your carbon generating capacity. But the drive towards higher scientific interrogation is also going to mean there must be a push on pricing because the demand for credits is also still very strong. So carbon is a evolving sector, and I think, as I've mentioned before, there is a lot of science that needs to go into it, and it would be good for Africa and Zimbabwe to contribute to the science, as opposed to have standards that are only being generated at an international level, which may not necessarily reflect the realities on the ground from a country-specific basis.
Okay. So for the questions, I can see there are many hands that are coming now. I'll just give the last two and she'll answer. You just ask your question, then she'll answer once.
Okay, thank you. I have two questions. I'll try to combine them into one. The first question, I would have loved if Madeline was still around to take from her vast knowledge of the financial markets. Going green. Is there a way that maybe as Africa we can collaborate and seek for maybe concessional financing so that we move from where we are, seeing that we are truthfully behind in terms of going green? Is there a way that we can collaborate as Africa and get that concessional those concessional loans at very much lower interest rates. Then the second question is basically for the accounting fraternity. I've heard a lot of talk about carbon credits. Have we started recording them? And at what value?
Okay, thank you, Karen, for the presentation. I think mine was linked to an earlier question, is to say, right now, based on where we are and based on some of the challenges that we've already been talking about to do with ethics and integrity, are carbon credits not facilitating even more of the greenwashing, even exploitation of those communities that people are said to be helping? You know, unless you are very ethical, it's very easy to just pay people to say, well, can you say the right things because we are all needing to get something out of this. And my concern is, I just don't know whether we have the mechanisms in place to really verify what people will be saying. Therefore, the integrity and the ethics, I think we needed to solidify that first before we really ventured into carbon credits. Otherwise, at some point, we could find out that it's a huge scam. Just looking at the fines that people have been getting, etc., and these are well-established economies, you know, it just becomes a big concern for me. What's your take? Thanks.
Okay, thank you for those last 3 questions, because we had 2 in 1. Concessional loans, there's a lot of talk now around blended finance. I don't think we have time to get into that now, but I think from the last conference I attended on blended finance, the one major challenge Africa has is the scale and the lack of pipeline of bankable projects. So I think it is a challenge to Africa as a whole, and perhaps bring it locally to Zimbabwe to say, how are we able to organize ourselves to aggregate certain projects? As Sakada, we're part of the Zimbabwe Carbon Association, and under that association, we are planning to now build a climate fund which will aggregate similar projects at different scales, with the view of then using that consolidated scale to tap into climate finance. There are some DFIs where if you're looking for less than 30 million, they can't even start the conversation. And so you find part of the reason why funding hasn't flowed to Africa is because of the smaller scale of our projects. On carbon valuation, this is a current challenge that we are facing, because as far as our finance and auditors have informed us, there's no actual accounting standard that addresses carbon. But what has been adopted widely across the global markets is valuing or classifying carbon as inventory, which is valued at the lower of cost or net realizable value. So at the moment, that is the general method of valuation that is being used. The last question on greenwashing, and this is going to be an ongoing debate around carbon, but I think with any new innovation, there will be risks. With any project, these are some of the issues that we're saying internationally. Carbon markets have gone through rigorous scrutiny. And as a result, a lot of the methodologies have been reviewed multiple times and are still being improved. Are there going to be hazards? We can't completely write off hazards. We produce tobacco and people smoke, and there's hazards to smoking. It's one example. But now we're saying these are projects that bring actual community benefits, which is why we're investing in doing all the habit surveys that we showed. The deaths that are caused by exposure to smoke emissions and inhalations is significant across Africa. And so when you look at the impact in reducing premature deaths from smoke particulate inhalation, when you look at the time savings for the women and the girls who don't have to spend 6 hours, trying to gather firewood, they, at the core of every carbon project is a sustainability impact, because you can't build a project without demonstrating the community or the sustainable development that your project will bring, whether it's water, filtration, whether it's access to energy, whether it's renewable energy, every project, whether it's small scale farming or conservation agriculture and improved yields. Essentially, we're saying that we can't lose sight of the fundamental reason why we're doing these projects, which is ultimately to promote sustainable development within our communities and leverage on the climate finance that it unlocks to pay for these initiatives.